I spend many hours researching income investments, but these guys can do it in about 3 minutes.
Wait, what? I thought this was supposed to be an ETF for income.
It is, but it seems like they're okay with having some stocks that don't pay dividends. Maybe they're trying to get more growth or diversification.
Those weren't real people talking. It was audio generated by AI. Today we'll look at how you can use AI to help you choose income investments and whether these guys will replace me. This new AI tool from Google has a cool trick. You can feed it a ton of information, in today's example, more information than I would want to read, and it will transform that information into a short podcast-style discussion. Let's see what happens if I drop the 10 most recent articles from Seeking Alpha about JP Morgan's JEPI fund, or as I call it, JEPI, into this new AI tool called NotebookLM.
But what's the deal with that 7% plus yield? We've got to dig into these Seeking Alpha analyses and figure out what's really going on.
You know, it's funny. When you really look at JPI, it's not just about chasing yield. It's about trying to make something specific happen in a certain type of market.
I like that. So it's like a specialized tool, not just a one-size-fits-all.
Exactly.
So impressive that the voices sound real and that they're reacting to each other in what sounds like natural conversation. The man used the analogy of JEPI being a specialized tool, not just a one-size-fits-all. I've listened to a few of these podcasts, and the hosts use analogies like that to explain concepts, just like humans do, which is pretty clever. We're not going to listen to the entire discussion, which lasts almost 11 minutes. I'll just play you some highlights so you get the gist of it. Let's continue.
Okay, so let's break this down for everyone. What makes JPI different?
It's using covered calls, right? But it's not just any covered call strategy.
Yeah, you're right. It's aggressive. They're willing to give up some potential gains to get that big yield.
So you're saying if someone's expecting JPI to outperform like a tech stock rally, they're going to be disappointed.
Right. You've got to be comfortable with that trade-off. You know, if you think the market's going to be slow and steady, then JPI's strategy starts to make sense.
One source even called JPI boomer candy.
Yeah, because it appeals to those income-focused investors, you know, maybe people nearing retirement who want stability more than huge growth.
They often pronounce JEPI as JPI, which is a little bit distracting. To get the discussion going, the man asked the woman, what makes JPI different? Once again, that's what humans would do. It's a little bit more interesting than just listing bullet points like other AI tools do. So this part presented the overriding theme of the 10 articles that JEPI delivers steady income, but at the cost of maximizing gains during a bull run. Let's take a quick look at that income. I wouldn't call it steady, perhaps variable would be a better word. And while we're here, let's check the yield history. You can ignore this ramp-up period in the first year. Okay, the current yield of just over 7% is getting close to the all-time lowest yield of 6.65%. This is always worth checking because if you buy it when the yield is up here at 12%, you wouldn't want to count on it paying 12% forever. These two charts came from Snowball, but I mostly use Snowball to keep track of my current and future income. I can visually rank my portfolio by current yield, check the yield on cost, and most importantly, know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. Let's hear what else they have to say about JEPI.
Some sources said JPI might actually look even better if interest rates go down.
Really? That seems kind of strange.
Yeah.
Why would lower interest rates be good for an ETF like JPI?
Think about it this way. When the returns on those really safe things like money market accounts drop, people start looking for other places to get higher returns. Suddenly, a 7% yield doesn't seem so bad, even if it has some downsides.
Once again, the conversational format is a natural way to explain a concept.
One source even said that smart investors, people who know about options, might be better off just buying the S&P 500 themselves and doing their own covered calls.
That's interesting, but it takes a lot more time and knowledge than most people probably have.
Exactly. And that's where JPI and those kinds of ETFs come in. They're easy. You get diversification. You can use a covered call strategy without having to become an expert yourself.
That's a fairly nuanced point. You could do it by yourself, but most investors would rather pay a fund manager to do it for them. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth. And this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's called Armchair Insider. I've also included links to the relevant videos so you don't have to hunt through YouTube's channel page. Link in the description, and it's free.
One source said JPI's portfolio might be too focused on just a few stocks, especially ones that have already gone up a lot in price.
Yeah, they mentioned companies like Progressive and Train Technologies. They've become some of the biggest holdings, but their prices have already jumped up a lot.
This specific detail is interesting. These two stocks that they mention are the largest and third largest holdings in the JEPI portfolio, and they've had an incredible year. Progressive is up 63% and Train is up 113%. Not bad for a company that makes air conditioners. The fact that JEPI was able to pick up some winners like these without blindly following the S&P 500 is something I'd want to know if I was considering buying this fund.
And to make things even more interesting, some of JPI's holdings don't even pay dividends.
Wait, what? I thought this was supposed to be an ETF for income.
It is, but it seems like they're okay with having some stocks that don't pay dividends. Maybe they're trying to get more growth or diversification. They talked about Vertex Pharmaceuticals. It's one of the top holdings now, even though it doesn't pay a dividend.
So the reaction of the guy, surprise and confusion, is just like a human. He said, wait, what? I thought this was supposed to be an ETF for income. So a couple of things about that section. First of all, VRTX isn't one of the top holdings. It ranks 24th. Amazon is a top 10 holding and it doesn't pay a dividend either. The AI thought this no dividend thing was controversial, but it's not really. The fund doesn't claim to hold a portfolio selected exclusively for dividends. It's a combination of dividends and the income generated by selling covered calls using equity-linked notes, or ELNs. And speaking of ELNs...
ELNs are equity-linked notes. They're basically contracts that JPI uses to do its covered call strategy. The problem is that these contracts add what's called counterparty risk.
Meaning there's a risk that the bank that provides those ELNs could have problems.
Exactly. If one of those banks had serious issues, it could affect how well JPI performs.
So it's another risk that investors need to think about.
Right. But to be fair, ELNs are usually considered pretty safe, especially when they're from big, well-known financial institutions.
Even though they don't go into a deep discussion about ELNs, it's good that they mentioned the counterparty risk. As long as you have confidence in the banks that issue them, the risk is fairly minimal.
Like maybe some investors are switching to other ETFs that they think will make them more money.
Like QDPL. It also uses covered calls.
No, that's wrong. QDPL doesn't use covered calls. It uses S&P 500 dividend futures contracts. Two different things.
But maybe the yield is higher and the taxes are better.
Exactly. And that brings up another important point, the difference between ordinary income and return of capital, or ROC, when you're getting those ETF distributions.
Right, ROC.
Yeah.
That's where you don't have to pay taxes on it right away.
Exactly. You're delaying the taxes, which can be really nice. The source pointed out that some ETFs, like QDPL, might have more ROC in their distributions, which could be good for people worried about taxes.
So even if JPI's yield looks bigger at first, it might not be as good after taxes. That's really important for anyone who owns JPI in a taxable account.
Absolutely.
They made a valid point. JEPI income is taxed as ordinary income, and there are some covered call funds that use return of capital for more favorable tax treatment, such as QDPL. I verified this on the QDPL website, which shows a significant portion of the distribution is indeed return of capital. And by the way, this is the good return of capital. It's not destructive to net asset value, as evidenced by the recent growth in the value of the fund. QDPL pays a lower yield than JEPI. QDPL's yield is currently 5.41%, but its total return makes up for that. If we compare total return for the two funds since QDPL's inception in 2021, we can see that JEPI outperformed during the 2022 bear market and QDPL outperformed in the current bull market. So the fact that the podcast included QDPL in a discussion of JEPI, I think, is useful, which is to say the fact that one of the articles from Seeking Alpha that I fed into NotebookLM, the fact that that addressed QDPL is really what's useful. So this is only as good as what you put into it, obviously. I entered 10 articles that ranged from strong buy all the way down to sell. So the podcast gave plenty of pros and cons. If you entered, say, 3 strong buy articles and that's it, then the podcast would lean a lot more positive. The information was mostly correct, but there were errors. I don't know if the errors were in the source material or the AI's interpretation of the source material, so you still have to independently verify the important data points. You could also try Chat GPT. It offers a short overview with pros and cons, but it's fairly generic. Also, I don't know where it gets its data, but I'm assuming it scrapes from free websites and they only give surface-level information. FYI, I'm using Chat GPT 4.0, which costs $20 per month. NotebookLM is free. You can improve the output from Chat GPT if you enter data from a paid source, like Seeking Alpha analysis articles. In this example, I asked Chat GPT to compare 2 Seeking Alpha articles about JEPI. The summary was okay, but it doesn't offer the podcast-style audio chit-chat feature. Also, Chat GPT cannot watch a YouTube video, but NotebookLM can. If you want to convert, say, 3 YouTube reviews of an ETF into a single podcast, NotebookLM can do that. NotebookLM's party trick is the podcast, but it also delivers written reports in a few different formats. Here's a written summary of the 10 Seeking Alpha articles I used to create the podcast. It calls this format a briefing. Here are a couple of ways you could use NotebookLM to help you find income investments. Number 1 is to filter new ideas. When I'm researching an income investment, I'll usually look at the website, the prospectus, investor presentations, the fact sheet, maybe an earnings call, and some Seeking Alpha analysis articles. Usually I'll read 3 to 6 of the most recent ones. After doing that, I often conclude that the investment isn't worth buying and isn't worth making a video about, and that's a lot of time. I could just drop some or all of these resources into NotebookLM, listen to the podcast, and decide whether or not I want to pursue further with that particular investment. The second use case is to expand the universe of information. If I read, say, 3 to 6 Seeking Alpha articles, instead I could drop 10 articles into NotebookLM like I did today and see if anything shows up in the podcast that I missed from reading less than 10 articles. If you're not using Seeking Alpha to help you choose income investments, I suggest trying it out. The ETF websites really only tell you the good stuff, and these analysis articles from Seeking Alpha cover the pros and the cons. I'll put a link in the description for a free trial and a discount. And I'll also link this video that walks you through the 4 features I use to analyze income investments. I take a lot of information about income investing and boil it down to the key points. NotebookLM does that too. It makes you think. I don't have a podcast, so we're not direct competitors, but it's just a matter of time before a video version of the technology will appear. Then it's going to come down, I guess, to credibility. While I was preparing for this video, I asked Chat GPT to evaluate SPYI, and it quoted a yield of just over 6%. That didn't seem right, so I asked it to add up the trailing 12 months of income and divide by the price. It then gave me the correct number, which was just over 11%. My point is that a human will use their past experience to question data that just doesn't look right. So at this point, I don't think AI will replace me, but in the future, it could learn how to get better at learning. My takeaway from this exercise is to keep experimenting with AI tools because some of them might save us some time or make us a more knowledgeable income investor. If you want to learn more about JEPI or QDPL, you can click on these reviews over here. That wraps it up for this look at NotebookLM from the perspective of an income investor. More Armchair Income coming soon.